Good afternoon, traders, and welcome to another edition of Rolling Trades. I'm Senior Market Strategist John Caruso. In today's podcast, we have prepared a number of slides for you. We're going to go through a couple of charts as well. I think we got some really interesting things. And of course, we are always going to start where I always like to start, and that is with the macro data. So we're just going to jump right into it. Of course, today is Fed Day as well. So we do have the Fed announcement at 1 p.m. And then, of course, that's going to be followed by the 1:30 press conference with Jay Powell. So we're just going to jump right into the slides here. We're going to take a look at GDP. I've got up here, you'll see two charts. We do have quarter over quarter. And then, of course, we have our year-over-year GDP with year-over-year headline CPI side by side. So what we're expecting right now, obviously coming out of 2023, we did see some 2024, we did see some fairly robust growth in the economy. And now, as we made the turn into 2025, we can start to slowly see some deterioration in U.S. GDP growth. Of course, over here, we did see that Q1 scare where we did see GDP quarter over quarter come in at minus 0.50%. A lot of that was due to the companies front running the tariff announcements on April 2nd. You saw a lot of rush to get imports in ahead of the tariffs, and that contributed to the Q1 disappointment. And then, of course, in Q2, we did get that strong rebound of 3.3 quarter over quarter. But however, as we take a look in the back half of this year, we are expecting a slower pace of growth. We do have Q3 estimates currently right around 2% year over year GDP growth. And of course, if we flip over to inflation, we did see inflation peak in 2022. We saw that 9.1% headline reading, 6% on the core. We did see inflation cool all the way from 2023 through 2024 and part of 2025, as you can see in here. And then, of course, we did make a bottom, or at least what we believe is a bottom in April at 2.3%. And then we slowly started to see a gradual warming up of inflation. Currently 2.9 on headline. We do have core CPI at 3.1%. And of course, we do have the Fed on deck later today, ready to cut interest rates. So it's going to be interesting to see how markets react to that. I think what we can say from here about the Fed cutting with core CPI north of 3.1% is that basically the Fed is abandoning their 2% inflation target that they've been discussing here for the last couple of years. So I do think that markets are pricing out that idea that we're going to return to 2%, and I think inflation is set to reheat from here. As the consumer turns, now we hear a lot about the consumer still being buoyant, still being strong. I think that is largely an overstatement. Just taking a look at the most recent University of Michigan consumer sentiment readings, we did see a reading of 55.4 just recently. That, of course, is retesting the 2022 lows that we saw. And, of course, if we know anything about consumer sentiment, that begets consumer spending and retail sales data, which, of course, begets GDP growth. And, of course, as we all know, the consumer consists of 70% of GDP. Switching over here, consumer inflation expectations. I think that this might have something to do with consumer sentiment coming in at 55.4. I think it does. Consumer inflation expectations 1 year out are forecasting 4.8%. Now that has actually cooled off from recent readings of north of 6%. And 4.8% still seems a little lofty from where I sit, even as an inflation bull. I do think inflation headline CPI is likely going to trend back towards 4% out in 2026. But right now, the University of Michigan inflation expectations 1 year forward, 4.8%. We are starting to see signs of a slowdown in labor. And of course, sentiment and sticky inflation, I think, has a lot to do with driving the downtick in consumer sentiment. Switching over here, U.S. core CPI still remains above 3%. As I just mentioned, we're at 3.1%, and we have the Federal Reserve on deck later on this afternoon, ready and willing to cut interest rates by 25 basis points. So this chart right here, we show sticky price consumer price index. This is core CPI. Of course, you see back over here, 1970s version of inflation. And then, of course, we did see followed by Paul Volcker when he took over the Fed and jackhammered inflation, took interest rates up to 20% on the Fed funds rate, and, of course, launched a 40-year bond bull market. Now, what's different today, as you can see, this looks largely different than what we saw back in the 70s, but we are starting to see this wave, and we do believe that inflation is likely to re-emerge from these current levels right here. The problem with today and what Powell faces is he doesn't have the same luxury as Paul Volcker had back in 1980 when he raised rates to 20%. Back then, the United States had a debt to GDP ratio of 30%. Today, as we sit here today, we have a debt to GDP ratio of 116%. So that's a big problem. If we do see an emergence of inflation come back, that's going to be something that we're not going to be able to handle in a similar fashion to the way that Paul Volcker did back in 1980. So flipping over here, signs of a labor slowdown. We are seeing signs that labor is slowing here. We did see a recent unemployment rate tick up to 4.3%. We did see back-to-back week jobs readings, August readings. Just most recently, a couple of weeks ago, we did see only 22,000 jobs created in the month of August. That did come in light. Expectations were 75,000. July, going back to July, we did see 73,000 jobs versus an expected of 106,000, and we did see revisions for June and May to the downside. So we are starting to see some signs that labor is beginning to slow. We are still, with the unemployment rate still at 4.3%, we are still below the Fed's year-end projections. However, the Fed certainly does not want to let the employment situation get away from them. The employment data is the most lagging data that we have in the marketplace here today. So, of course, this is stoking the Fed to cut interest rates here today, and we believe that they're going to follow today's rate cut up with two more cuts in October and, of course, in December. And then, of course, we did just most recently see the labor revisions between March 2024 and March 2025 be revised down 911,000 jobs. Now, that took place a year ago, but it is certainly a pretty jarring revision that we saw. As a matter of fact, I believe that was an all-time high in the revisions. Switching over, more signs of slowing labor. We are seeing the labor force participation rate perhaps begin to peak and roll. We've had a pretty steady labor force participation, but now we are starting to see some slow signs of that beginning to wane. Switching over to JOLTS, more signs of slowing in the labor force. A notable slowdown in job openings. That is also a trend that is difficult to reverse, and I think that the Fed is just trying to get ahead of that right now. All in all, we have fallen back to about 7.1 million, which is about the 10-year average in job openings, but certainly we are seeing a downtrend take hold in JOLTS, and I think the Fed is trying to get in front of that. Taking a look at the Federal Reserve later on today, of course, max political pressure to cut interest rates and perhaps gasoline on the inflation fire. If you take a look at the chart that we have in here, that is the 12-month projection of where the Fed funds rate is going to be come this time next year. 2.75 to 3% is the target. Currently, we're at 4.25 to 4.5. After they cut today, we'll be 4 to 4.25. So you're looking at about 150 basis points lower in the Fed funds rate between now and this time next year. You got to remember that President Trump will be announcing a successor to Jay Powell. From what we've heard, could happen in a matter of the next few weeks, and we believe that he's certainly not going to be installing a hawk into that role at the Fed. So lower interest rates are set to come. Of course, President Trump, he's applied maximum pressure on the Fed to cut rates. Of course, he knows that we have $9 trillion in federal debt that matures in 2025. That needs to be termed out. Of course, he wants to refinance that at as low of interest rates as he possibly can. And the U.S. housing market still remains locked in at lower rates. You got rising home values. You've got rising interest rates, which has certainly locked up sellers and would-be buyers in the housing market. So the housing market has basically been at a standstill now for the past 12 months. So as we see it, this is how we see it right now. The Fed will acquiesce to higher inflation due to the recent slowdown in labor. The Fed needs to stave off a broader slowdown in housing, specifically in labor, to continue to harbor productivity growth, GDP growth, all in the name of servicing the United States debt. So that's the reality of where we're at now. Now, how do we make money on all this? Let's take a look at our commodity performance chart year to date. Platinum, silver, and copper, all in multi-year supply side deficits. Look at platinum right there at the top, up 51% year to date. Silver not far behind at 41%, and gold at 39%. So what that is telling you is that you've got robust demand, foreign demand coming in for precious metals. The demand for gold has by foreign central banks has been insatiable to date. And of course, gold is the antithesis of the U.S. dollar trade. And with the fiscal situation the United States finds himself currently in, it is the knee-jerk reaction by policymakers to seek a weaker dollar policy, lower interest rates, and continue to blow out the deficits. Deficits are going to average, they're expected to average over the next 10 years approximately 7% of GDP. So weaker dollar policy, higher deficit spending, all of that equates to buy gold. And that's where we're at. Gold, we do not view gold as a currency or as a commodity. We view gold as a currency. USD, take a look at the USD. We do have that down 11.46% year to date. I do believe the U.S. dollar is likely going to continue lower over the next 12 months as the Fed continues to lower interest rates and the Trump administration seeks a weaker dollar policy. Flipping over here, we're going to take a look at the gold chart as we just hit on. Gold just recently went through about a 4-month consolidation period that started back in April. The consolidation zone was about 200 points wide. So the larger the consolidation period and the larger the zone, it begets a very big breakout for that particular market. And we are seeing that right now in the gold market. Gold trading at 37.17. Even if we get modest corrections in here off of this trend line that we've seen, which would be around 36.50, maybe even as deep as retesting the old breakout at 3,500. I think it's going to be a tremendous buying opportunity for gold to try to reach towards 4,000 by the end of the year. Of course, gold is considered a tier 1 asset. Central bank demand remains insatiable for gold. Shanghai Futures Exchange gold inventories. Look at those go parabolic over in China. The silver monthly chart. Now, here's a market that I believe is just starting to get, this market's just getting going right now. 42.40 in silver last trade going into the Fed. We do have a little bit of a near-term overbought signal. But any corrections down into $40, perhaps as deep as $38, we're going to view those as terrific buying opportunities. We have been rolling a long gold and silver position with clients now for the past 2 years. So our clients have been enjoying that move in markets. And certainly, I think you have to own these assets going forward, especially with what we just talked about. The U.S. Treasury seeking a weaker dollar policy, debt and deficit spending, and of course, lower interest rates likely to come at the short end of the curve. There's another headline just recently. India's silver imports to gain momentum from strong investment demand, making the case for silver demand. Now, what is driving a lot of this move in the precious metals markets and, of course, in the broader commodity basket is, of course, what we've been harping on here is the weaker U.S. dollar policy. U.S. dollar down 11.5% year to date. That is a massive move for a currency, for a major currency like the United States dollar. We believe that is going to, at some point, retest the 2011 lows down around 70. Now, that could take 12 to 24 months for that to happen, but we do believe that we are seeing a systemic downtrend going forward for the U.S. dollar. Clearly, we had the breakdown. We had a retest of that 100 level several times, 3 times to be exact. And then on the 4th time, we did see a break through that key 100 level. Dollar devaluation policy perpetuated by debt and deficit spending. The big, beautiful bill, of course, is expected to tack on or expected to increase deficit spending on average over the next 10 years of 7% to GDP. Lower interest rate policy, as we've mentioned, and higher global capital flows to gold from foreign investors. So there is the main driver for what we believe we are entering a secular bull market for the commodity space. Market Pulse. Every morning I write a market insight note. We hit on a lot of these subjects that we hit on here today. We go into even more depth. We talk a little bit about our trading and investment process, and we dig a little bit deeper into the quantitative aspect of what we do and how we assist clients with timing signals, grossing up trades, degrossing trades on overbought, and generally just trying to point our clientele in the right direction based on the current market cycle. And once again, thank you for joining me here today with another edition of Rolling Trades. And don't forget to ping me at jcaruso@rjofutures.com. We'll add you to our Market Pulse insights every morning, as well as our directional trade signals. Best of luck to everybody out there. We'll catch you back here next time.
The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance, whether actual or indicated by simulated historical tests of strategies, is not indicative of future results.